Something fundamental is changing in housing, and anyone planning to buy, sell, or move over the next handful of years really needs to understand it. For the first time since the financial crisis, the market appears to be going through a major reset. And it's not another 2008 style collapse. It might be much slower and more permanent shift on who can afford a home and who remains locked out. Morgan Stanley recently warned that the next version of the housing market may be one where mortgage rates remain elevated, affordability never really returns, and inventory stays restricted, and home prices never actually decline enough to give the typical buyer the relief that they've been waiting for. In other words, the crash many people expect may never arise. By the time that becomes obvious, properties that they could have purchased may actually be further out of reach. This is why this deserves a closer look. We need to understand why the housing market has become so frozen, why the situation could become more difficult, and what all of this means for your equity or someone deciding whether to buy, sell, or continue waiting. If Morgan Stanley's outlook is even partially correct, the most difficult stage of the market may not be the one that we're living through today, but it may be what comes next. Before we get into it, make sure you subscribe, send me a message, comment down below. If you want more housing breakdowns without the headlines being stripped of context, these topics are complicated and the details matter far more than dramatic predictions. To understand what might happen next, we need to understand where the market stands today in 2026. And that starts with what has been a prolonged housing freeze. Morgan Stanley updates its housing look periodically by reviewing price movement, supply, demand, mortgage conditions, and broader economic trends. Its latest conclusion is not one that the market is approaching a sudden collapse. Instead, the firm believes that housing may be settling into a different structure entirely, one where prices remain historically high, continue moving upwards over time, and just stay there. At the moment, the average 30-year mortgage rate is about 6.5, and even though that level represents, a 7-week low for, the time that this video is being made, at the time, at this time, the median house price has reached about 429,000, about 1.3% higher than it was last year or earlier this year. The combination has not really improved affordability. It's made the monthly cost of ownership harder for many households to absorb. Another major reason why Morgan Stanley describes this as the lock-in effect. Millions of existing homeowners financed when their properties were dramatically low. Roughly about 70% of homeowners with mortgages have rates below 5%, and half of those are below 4%. For someone in that position, selling often means giving up an unusually inexpensive loan and replacing it with financing that could make the next home payments substantially higher. This creates a powerful reason to stay put. Even people who might normally move for more space, a different location, a job change, or even a shift in lifestyle are looking at new payments deciding not to go anywhere until rates fall enough to narrow that gap, and a large part of the market remains frozen. And new construction has not been able to fill that shortage quickly enough. The result is a market where housing can remain unaffordable while a limited number of homes become available for sale and prices continue soaring. Turnover has fallen to its lowest level in roughly 4 decades. That weakness has been persistent for 11 consecutive quarters and creates an unusual standoff. Buyer demand is restrained because the cost of purchasing is too high, but the seller's supply is also restrained because existing homeowners don't necessarily want to surrender their low mortgage rates. Two of those forces really offset each other. Weak demand would normally pull prices down. Weak supply usually prevents that adjustment from happening quickly as buyers expect. So instead of a broader crash, prices remain stubbornly high while a large group of would-be buyers continue waiting for meaningful decline that may not arrive anytime soon. And that leads us to the second issue that's receiving less attention, and that's the affordability trap. Harvard recently published its own warning about this long-term direction of housing affordability. Morgan Stanley's arguments largely financial, right? Rates, inventory, prices, the lock-in effects. However, Harvard arguments goes a little bit deeper. It suggests that the version of home ownerships and many Americans consider normal may have been created by a unique historical period rather than conditions that naturally continue forever. For much of the post-war era, home ownership expanded because several favorable forces has happened at the same time. After World War II, approximately 16 million veterans returned home within a relatively short period. The federal government needed a way to help these people and these, service members reintegrate into civilian life, finding stabilities, begin families, and start participating in the economy. Housing became a major part of that solution. The country had inexpensive land, relatively accessible financing, strong government support, rapid construction, rising wages, and millions of households ready to form. The environment was unusually favorable, expanding home ownerships on a massive scale. The GI Bill helped make that possible by giving eligible veterans access to federally supported mortgages with favorable terms, like little to no money down, and that financing did not happen in isolation. The country was also building highways, suburbs, schools, businesses, utilities, but many of those conditions don't last indefinitely. Today, many of the forces that expanded ownership have moved in the opposite direction. Mortgage rates are higher, construction is slower and more expensive. Zoning is restricted in many places while insurance costs have skyrocketed. Wages have not kept the pace with prices either. As a result, access to ownership increasingly depends not only on what a household earns, but on whether that household already has enough equity, family assistance, inheritance, and other assets that can help fund the purchase. This is what makes Harvard's warning so significant. Homeownership is beginning to look less like something people can reliably achieve through wages and more like something that's transferred through existing wealth. Now, if that trends continue, the housing reset is not only about higher rates or low inventory. It's about widening the divide between people who already own assets and people who are trying to enter the market for the first time. So what does that mean over the next several years? When could price soften? What happens if mortgage rates actually decline? And how someone looking to make a decision without panicking into a purchase or waiting indefinitely for conditions that may never return. Morgan Stanley's answer is uncomfortable because it runs against what many buyers still expect. Morgan Stanley believes that housing is moving towards a new normal. Its message is not that everyone should rush to go out and buy immediately. It's that waiting for affordability to return to its pre-2024 may be unrealistic. Now, that doesn't mean that buying a property at any price, accepting a payment that strains a household budget, or assuming values can never decline. It means that buyers should be careful about building their entire plan around a 30% price reduction or a return to a 3% mortgage rate. These conditions may not appear for a very long time, if ever. The more practical approach is to buy only when monthly payments work, emergency funds are established, and property can be held for years. And the decision still makes sense without relying on immediate appreciation or a guarantee of, a refinance. Don't buy because of fear. But don't wait forever for a market that, may not ever come back. Morgan Stanley's outlook can be summarized through 5 major predictions. The first is that home prices are going to remain high. Housing may be stuck between 2 opposing limits. Prices, do not collapse because there's not enough inventory, and most homeowners are not under enough financial pressure to actually sell. At the same time, prices don't surge at the pace that we've seen earlier in the decade because affordability is already stretched. The likely result is not that we're going to have a dramatic boom or bust. It's a slow, expansive market where prices move unevenly and remain supported. The second prediction is a new equilibrium. This one's interesting. Buyers and sellers gradually adjust to higher costs simply because those costs persist. A 5.5% mortgage could eventually feel really attractive after a long period of 6.5%. A $2,500 monthly mortgage period may start to really look reasonable compared to a $3,000 current rate. Now, that doesn't mean that housing is unexpected. It means that people begin to measure affordability against new environment rather than against the unusual cheap financing of the past. And buyers waiting for the old version of normal may eventually have to accept that it's not coming back. And when rates fall, more buyers enter the markets, competition increases, and that renewed demand supports prices. Now, when rates rise, buyers pull back, but existing owners also become even less willing to sell. Inventory tightens and activity freezes again. Either direction, it creates its own obstacle. The third prediction, Morgan Stanley, is stronger rental demand. While households can't afford to purchase, they don't just disappear. They still need a place to live. More demand shifts towards apartments, single-family rentals, and build-to-rent communities. These benefits owners who already control the rental inventory while making the path to ownership even more difficult, or tenants trying to save. The fourth prediction is that it's a continuing supply problem. Lower mortgage rates alone would not solve the shortage because rates are only one part of the issue. Permitting, zoning, insurance, all those things quickly affect affordability and how housing can be created. So do construction costs, labor shortages, infrastructures, and land prices, all those things matter. Millions of households want the same, at the same time of those existing owners need to have a reason to sell. Ironically, because rates decline, buyers are waiting for, could bring back much demand into the market that pushes prices higher before supply actually has time to respond. The fifth prediction is a broader chain reaction across the economy. Housing activity supports far more than sales itself. A purchase can lead to spending on furniture, appliances, repairs, remodeling, landscaping, moving companies, insurance, local services. When transactions are low, the surrounding activity also weakens. People relocate less often, job changes are less freely, delays on household formation, and spend less on home-related goods and services. A frozen housing market can therefore reduce mobility and economic availability well beyond real estate. Not every analyst agrees with the same forecast, and different markets are going to behave differently. To understand the range and possible outcomes, it helps to look at several other predictions for the housing reset. Zillow's latest outlook anticipates modest price declines in selective markets, including places like California, Florida, and Texas, where affordability and recent supply growth have placed more pressure on prices. Other East Coast markets could continue seeing appreciation because they began from a lower price level or still have tighter inventory. Realtor.com reaches similar broad conclusions. It doesn't project a nationwide correction large enough to restore affordability quickly. Over a much longer horizon, its projections suggest that home prices could approach $1 million by the time many millennials reach retirement age, which is roughly 25 years from now. CoreLogic has offered even stronger short-term outlook, projecting that the national home prices could increase another 5% year over year as pent-up demand competes for limited inventory. More market activity also begins concentrated among buyers with significant equity or cash because those buyers are less affected by mortgage rates. Now that can widen the gap between existing owners and first-time purchasers. Fannie Mae also outlined longer-term scenarios. In its more conservative case, home values are predicted to rise about 5.3% through 2023. Its base case projects approximately 13.6% of growth, while stronger scenario reaches about 21.6%. Shorter-term forecasts remain more restrained. The Mortgage Bankers Association expect prices to remain relatively flat for the foreseeable future. Taken together, the consensus appears to be that in 2026 and 2027 may bring more of the same rather than a dramatic resolution, and sales activity remains slow. Prices stay flat, and in some markets possibly rise 1 to 3%. In other rates, if rates eventually decline, transactions may increase, but renewed competition could place additional upward pressure on prices. Over the long run, many forecasts expect home values to return to the more typical appreciation of 1 to 3% annually, with mortgage rates potentially being closer to 5 to 5.5. Now, there's another important distinction. A higher price dollar doesn't always represent a higher value after inflation. If a home appreciates 3% during a year where inflation comes up 5%, it's a nominal price increase, but it's the inflation-adjusted value declined. Some economists believe that maybe how housing affordability ability eventually improves. Instead of dramatic housing crashes, inflation and wage growth could gradually catch up while home prices move sideways or rise more slowly. The market could rebalance through time rather than through a sudden collapse. My view is that Morgan Stanley and Harvard are directionally correct. Barring a severe economic downturn that creates a widespread forced selling, a nationwide housing crash just doesn't really seem to appear to be, the likely outcome. The more plausible scenario is a slow reset in a market with higher prices, higher financing costs, lower turnover, and a greater dependence on existing wealth. That means anyone waiting specifically for 2019 prices may be waiting for a market that's not coming back. But that doesn't mean that every person should buy, and that doesn't either mean that renting is a mistake. The decision still has to be based on the actual numbers. The first practical takeaway is don't build your plan around a housing crash. Individual markets can decline and certain properties can absolutely lose value, but expecting a broad 30% correction as the only path to affordability is probably not a right way to think about it. A purchase that may make sense when the payment is comfortable, the buyer could still imagine it through an income disruption, and the property fits a 7 to 10 year ownership plan. The decision does not depend on immediate appreciation, and that's key, right? Long-term thinking. The property price and financing all need to work out under today's conditions. The second takeaway is that refinancing, if rates eventually fall and savings justify the cost. Someone who purchased an affordable property today may have an opportunity to improve the loan later. That's a benefit. It's not a guarantee, right? Buyers should never stretch into a payment that only works if the refinancing does eventually come available. Rates have remained high for far longer than many forecasters expected, and there's no promise that the next decline will be fast or even substantial. The third takeaway is that there's no shame in renting. Some markets, the cost to rent a comparable home is far lower than the actual full monthly upfront cost of buying, right? And the difference the difference that can be saved or invested, renting may be a stronger financial decision. Rent is not automatically wasted money. A renter is paying for housing flexibility without committing a large down payment, taking on maintenance risk, or tying up capital in an illiquid asset. In many locations, renting currently makes sense more than buying, even if family members, friends, or social expectations say otherwise. The decision should be based on today's purchase, today's interest rates, today's rent, and buyer's actual goals, not the numbers that worked for someone, a handful of years ago. For generations, Americans have been told that owning a home is a central path to long-term wealth. Harvard's argument is that the belief developed during a very specific period where land, financing, construction, wage growth, and government support made ownership far more accessible. That period shaped a culture, but it doesn't mean that every household today must purchase a home to build financial security. Someone may buy this year, rent for another 5 years, or continue saving for a decade. Any of those choices can be reasonable when supported by the numbers and the person's broader financial plan. The important thing is not to let the headlines make the decision. Don't buy because someone says prices are never going to fall. Don't stay out of the market solely because someone promises a crash, right? Compare the payment, the property, the time horizon, the alternative, and the risks. Housing may enter a more expensive and unequal era, but the best response is still the same. Understand the numbers, protect your flexibility, and make the decisions that work in your own life. There you guys have it. Joel with Real Broker. Thanks for watching. Subscribe for more practical housing analysis. And if you have any questions about the market, specifically where you're at, feel free to reach out, and I'd love to have that conversation with you. Until next time,